Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to us by GreenTraderTax.com. We're very pleased to have with us Robert Green of Green, Neuschwander, and Manning, as well as the CEO of GreenTraderTax, to deliver today's presentation. So with that, let me go ahead and pass you the controls, Robert. If you would go ahead and share your desktop, we'll get underway here this afternoon. Thanks for joining us, Robert.
Thank you, Cynthia.
You can hit later.
I had changed some settings the other day. Can you see everything okay?
Yes, if you put it into slideshow mode.
I want to just minimize the control panel. Hold on. Okay, everyone, sorry for the technical glitch. Welcome to today's session, Trader Tax Strategies 2019 Year-End Update. Well, that brings to mind year-end planning. We're going into the year-end. There's a lot of things to do. We're going to have two webinars, one today and one coming up in November on year-end planning, so you want to catch them both. So I'm founder and CEO of Green & Company, Inc., and also managing member of Green, Neuschwander, and Manning. You'll see me in all the leading media. You can check the whole bio later on. We're a CPA firm dedicated to the needs of traders, investment managers, other types of clients. We focus on tax compliance. That means preparation and planning. That's the key thing, planning before year end, when you can really do something to save money, avoid a wash sale, get lower tax rates, open up expense deductions. We help with accounting. For example, on securities, it can get complicated with wash sales. Consultations, people want to get me on the phone to ask if they qualify for trader tax status. Do they need an entity? And then we can form the entity. And lastly, if you have problems with the IRS or state with exams, which we hope that you don't have, we have an excellent record on that. We help defend you to the very end. And we have this excellent virtual communication process so we can work with clients in all states and U.S. residents abroad around the world. Traders can go everywhere and we go with them. So today this information is educational. It's not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Where you need that advice, you should get it from a competent expert. We're a CPA firm. We're not a law firm. We're not investment advisors. Now, Robert Green, that's me, and the Green Companies, we are not affiliated with Interactive Brokers. They have a great webinar program and they work with third parties, and we're really happy to be a tax partner for them. Here's the webinar description today. Trader tax status benefits. I coined that term, trader tax status. It means you're in the business of trading. It unlocks a whole panoply of benefits. But how do you qualify? That's very nebulous. It's not clear. There's no bright line test. I walk you through the golden rules that we put out. Once you get there, it unlocks, first of all, a ton of business expenses, whereas investors get nothing when it comes to investment expenses. They get just a few deductions. We'll go over those shortly. And then with trader tax status, you can also get out of wash sales, go into mark-to-market accounting, get into a retirement plan, health insurance. It opens the door to everything. Now we're going to go through also tax treatment for the various financial products. These days, there's a bevy of products to trade. The commodities exchanges mimic the securities exchanges and vice versa. There's all flavors of instruments, derivatives, and the tax treatment varies. It really muddies the waters. Plus, there's short-term versus long-term and wash sales and mark-to-market accounting. Realization method, it can be a nightmare if you're not on top of the basics. And you don't want to just solely rely on the 1099-B because brokerage firms are not tax advisors. They're doing the best they can and getting information from exchanges for tax treatment, and they're trying to fit it into neat little boxes like securities or 1256. But you're going to see there's a lot more boxes than that, and where you put the instruments can vary according to IRS rules for taxpayers, which can vary from rules for brokers. You just want to know what the rules are so you can get the best tax treatment available. Why pay an ordinary tax rate when you can pay a lower 60/40 rate from 1256 contracts? Why get hit with a wash sale loss deferral when you're not really subject to a wash sale? Why not take advantage of 475 ordinary loss treatment on everything possible so you don't get stuck with a capital loss limitation? Your local accountants may not understand all these nuances. That's why I'm glad you're here today. Listen in, and then go back and watch the recording later on to bone up a little bit more about it. So as I mentioned, we're going to discuss that wash sale loss adjustments on securities. We're going to talk about the Section 475 tax loss insurance, exemption from wash sales, exemption from the capital loss limitation, and 475 unlocks that great new 20% qualified business income deduction. That's what we're going to do today in a nutshell. So let's start with trader tax status. With eligibility for TTS, traders get several tax benefits that investors do not. So focus now, because you might realize today, during this session, that you are eligible. You didn't have to elect it. You didn't have to claim it earlier. You can still deploy it for the full year 2019 or for part of the year. Maybe you started off the year as a trader and stopped, or maybe you started trading mid-year. So you want to know what you can still claim for 2019 and then improve your year-end planning to take advantage of that status. Now, investors, they get so little, and the new tax law made it even less. So trader tax status benefits. These are the benefits. 1, you're going to deduct business expenses. Startup costs, those are your business expenses going back 6 months before you started up. Your home office, which is a huge deduction for traders. You add up all these expenses, they're $5,000, $10,000, $15,000, $20,000. It depends on what you have. If you come off of Wall Street and have a Bloomberg, an outside office, and staff, you're talking about huge numbers. But the normal, typical online trader, they have a lot of tools from the brokers. They may not have a ton of expenses. So there's a lot more to trader tax status than just the business expenses. But let's not play that down. If you can save 5 or 10 or 15,000, that's wonderful savings. Next, you can elect Section 475 on securities to be exempt from the wash sale losses. Last year, going into the year end, remember we had that big market sell-off in December. People did tax loss selling. Smart thing, they booked the losses. But then there was this huge rally in January. People didn't want to miss the rally, so they got back in less than 31 days, and they triggered a wash sale loss from the prior year end. But maybe they figured it was better to catch the rally. That's a decision to make. But you should at least know what the decision metrics are. You don't want to get slapped with this huge wash sale loss income at year end when you get your 1099-B and first realize it then. You want to know in advance, because there are a lot of things that you can do to avoid that wash sale. And why not do that if it's a good market move for you? Remember, market moves come first, tax moves come second. You don't have the tax tail wag the dog. That's going to get you into trouble. All right, so the 475 is going to exempt you from the wash sales, exempt you from the 3,000 capital loss limitation. If you lose a lot of money, you don't want your accountant to say, well, we could only deduct $3,000 against your wages. That other $100,000 you have to carry over to the subsequent years. It's a deferred tax asset. With 475, it's not. It's a full ordinary loss that you can offset against income of any kind this year. Now, there's a new benefit with 475. Traders who are eligible for TTS and who have 475, if their income is not too high, they're going to get a 20% QBI deduction. That qualified business income under the new tax law, that pass-through entity deduction. Trading is a service business, so it's restricted to income. And so if you make a lot of money, you price yourself out of that deduction. But if you don't make a lot of money, you get that deduction. but not with capital gains, only with 475. Lastly, if you're a TTS trader and you set up an LLC with an S-Corp election, you can pay yourself officer compensation going into year end. That's what we're going to do for our clients this year with the S-Corps. We're going to say, okay, your health insurance was $2,000 a month. That's $24,000 for the year. We're going to put that on the W-2 as wages. That's the entity deduction. Then you're going to get the $24,000 health deduction on your individual return. So we unlock a $24,000 deduction that a sole proprietor trader cannot get. And there's no offsetting payroll tax. And on top of that, we can do a high deductible retirement plan like a solo 401k up to $62,000 if you're age 50 or over, or 56 if you're under age 50. You're talking about big money, folks. Big. Now, there is payroll tax related to the retirement plan, but if you're paying a 15.3% payroll tax, the employer and employee share, but getting an income tax deduction, federal and state, at well over 30%, you're putting that 15 to 20% net in your pocket. These are the benefits that we're talking about. They really add up. I mean, that tax loss insurance can save the day if you have a huge loss, but let's hopefully you have huge gains and then maybe get the QBI deduction and not worry about the wash sales at year end. Let's step back. Investors have few tax deductions. The new tax law, TCJA, suspended investment fees and expenses, along with all other miscellaneous itemized deductions subject to the 2% floor. That's what you used to deduct your investment fees if you had an outside investment advisor that you were paying management fees and incentive fees to. If you had all sorts of, computer, seminar, anything, seminars were never really deductible for investors. But all your expenses that might have been other miscellaneous itemized deductions subject to the 2% floor, they're all gone. There's nothing left. There's only two things that are left. Two itemized deductions for investors remain. Investment interest expense, that's your margin interest, limited to investment income, otherwise it's a carryover. That's the same as it was before. And stock borrow fees. So you borrow hard to borrow fees from your broker to sell short. That's an other itemized deduction. That's like one of the few remaining other itemized deductions on Schedule A. Now, keep in mind the standard deductions roughly doubled, 24,000 and change, and it's indexed for inflation. For married, 12,000 and change for single. So you may not even take an itemized deduction, especially with that SALT, state and local tax cap of 10,000. So if you got a SALT cap of 10, you don't have a mortgage, you paid it off or you're renting, you have no itemized, you have no margin interest, you have no borrow fees, your charity is only 5,000. You're not, if you're married, you're not over the standard deduction. So investors, they're getting peanuts. Now, what do investors get? What's the one thing they get? They get a long-term capital gain and they get deferral. And everything else is to make you pay for that benefit. So there are wash sale loss adjustments. If you just jump out of a stock at year end to book a loss and get right back into it, the IRS says, come on, you're gaming the system. That's not really an economic loss. You took the loss on the books, you got back in really quickly. That's not an economic loss. 31 days is the limit. They've never changed that over the years, like the 3,000 capital loss limitation never changed over the years. That's crazy. That's an eternity, 31 days in today's short-term environment that we're in with rapid fire market movements. And short-term capital gains are taxed at the ordinary rate. So if you're a long-term investor, if you're Steve Jobs and you never sold a share of Apple stock and gave it to your wife with stepped up basis and never paid an estate tax, good for you, that's great. But if you're selling stock and paying the ordinary rate and have wash sales, you're not so happy with the investor rules. But listen, long-term investing is wonderful. A lot of traders, they don't trade every dime they have. They have in segregated investment positions. That's smart. To have deferral, to have long-term capital gains, a lot of hedge funds do it. It's smart too. But we're talking more today about your active trading program. So what does it take to qualify for trader tax status? Can you just open up a book and it tells you exactly what to do? Well, if you open up Green's 2019 Trader Tax Guide, it will tell you what to do. And if you buy that today, it comes with the 2020 free upgrade, which will come out in January. So you can get going on it now. There won't be a huge number of changes this year because we didn't have a new tax law. We just had some new regulations and updates and things. So here are the golden rules that I've put out with our firm. You know, when I say I, it's because I'm writing the content, but it's really we, our firm. I have great partners, Darren Nushwan, Adam Manning. We have great CPAs, tax attorneys. We all work on this together. It's based on years of experience working with clients and the IRS. So, in tax court cases, one case that I happen to like is the Pope Court. So some of these numbers come from the Pope Court. Substantial volume. Let's go over the big three. There's about 8 or more, but let's go over the big three first. Why did I call them the big three? Because the proof is in the pudding. These are facts that the IRS can assess. This is not like intention, which is hard to go into your mind. So substantial volume, at least 4 total trades per day. Scaling in and scaling out counts. If you put on multi-legged complex options trades and you put on the legs separately, not the broker automatically, you might be able to count each leg. So I'm looking for, let's say, 2 buys and 2 sells, 2 round trip trades. There's 4 total trades. I'm counting total, not round trip. There may be 4 buys. There may be 3 buys and 1 sell. Executed trades, not unexecuted trades, not option assignments, actual closing trades. So I'm looking for about 15 per week, 60 per month, and 720 per year annualized. So if you start mid-year, it's half to 720. And then you got to be consistent in hitting these numbers. That's the volume. Now frequency, I'm looking for a trade execution on 75% of available trading days. So you want to look at your market days, the days the markets are open. Take out the holidays that the markets are closed. So look at your own personal holidays, your own personal sick days, days off. How many days could you have traded? And then how many days did you actually execute at least one trade? And it comes out to about 3 to 4 days a week, closer to 4. 4 would be 80%, 3 is 60%. I'm looking for closer to 4, 75%. The tax court cases start ruling out at 50%. So I'm looking for a little cushion here. It's close to 4 days a week. Now this next factor is the most important, actually is the only bright line test according to the court cases. That's average holding period. Now is it weighted average? How is it calculated? That's not clear in the tax court yet. It's got to be under 31 days. In the Endicott court, Mr. Endicott, they call it the Endicott court, he had trades on 45, 60 days. He had a core positions and he managed risk and options around those positions. He never ring fenced his trading into a separate entity or a separate program. So the IRS looked at everything, the investments and the trading. The investments watered down the trader tax, the 31 days. He was over 31 days, and that's a bright line test. So you want to be comfortably under 31 days. That's the big three. You don't want to have continuous sporadic lapses. You're a grandparent, 1 month visiting the grandchildren, 1 month trading, 1 month golfing, vacationing, 1 month trading. No, this is a business. You don't close the bakery doors, 5 months a year. I mean, you can have a vacation, but this is a business and it's got to be open and consistent, regular, and significant. Time spent. This is one that's hard to prove out. You can, save a cache of your login sessions, but still it doesn't mean you're paying attention. So I'm looking for 4 hours a day. There's no material participation rules here. This is not Section 469 passive loss activity. Under the trading rule, it's exempt. Traders usually blow away the IRS with the work spent. I mean, there's a lot of work put into trading research administration. If someone tells me they have 100 trades a day and they spend a half hour, I ask them, are you doing automated trading? They usually say yes. If they don't write the program, they don't get credit for the trades. Then they're just a passenger. They're not a pilot in the cockpit, to use the airplane metaphor analogy. Intention. It's got to be the intention to run a business. This is not an investment activity. You're looking to make a living, primary or supplemental. This is the intention. Even if you're losing money perennially, it's not, the hobby loss rules don't apply. You don't have to make a profit in 3 out of 5 years. It's not recreational or personal in nature. So we don't need that backup test. You should have a respectable business setup, which a lot of traders do. I ask them, how many computers? Oh, I have 1, 2, 3. My iPad, iPhone, how many monitors? I have multiple monitors. I have a powerful trade workstation. I'm doing stuff in the cloud. I have a home office, usually used exclusively for trading, but sometimes it doesn't pass the exclusive use test. You can cordon off an area of a room that you use exclusively. After all, if you have a desk with some powerful equipment, you don't want the kids playing with that. Materiality. You should be a patent day trader with 25,000 for securities. Otherwise, you're not going to be able to trade a lot, and you probably won't hit the numbers for TTS. Now, if you go into futures or options, you can have less. The patent day trader rules might not apply, but I still want to see 15,000 to be material. But it depends on your net worth, and you can check with me. There's not a bright line test on that. So do some more reading on that on our blog or in the guide to see if you qualify. If you get into an IRS audit, they may just say, oh, you don't qualify. You're, because they pull out a case that maybe doesn't apply to you. So you want to check in on our golden rules and maybe check in with me. It's I assess your facts and circumstances. Now is a good time to do it because we're getting into year end. Again, it's something you're going to claim. You didn't have to elect it. So if you rise to the level of TTS, then you can deduct business expenses on Schedule C, or if you're trading in a partnership or you're trading in an S Corp. Remember that the account has to be in the name of the entity. So it's sort of like putting the bread in the oven. You pull the bread out of the oven. If it rose to bread, you got TTS. Otherwise, it's flat bread and you don't have TTS. And it's something you really need to do on a year-to-year basis. The IRS did not require an election statement to claim or to elect TTS. After all, you could say, I want to elect it. So what? Did you meet the requirements to do it? That's why the onus would not be on an election. The proof is in the pudding. It's in the bread. Now, you may also want to use Section 475 MTM, ordinary treatment, but you had to file an election for that by April 15, 2019. So 475 is like grad school that you got to elect on time. And TTS is like undergraduate school that you just, you self-school and you claim the diploma. But if you want to go to grad school, and not everybody does, then you had to elect 475 on time. So you got the TTS. You passed muster on our golden rules. What do you get for it this year? You get a whole list of business expense deductions that you would not get as an investor. Remember, the investor gets those 2 measly itemized deductions. Everything else, not deductible. As an individual, sole proprietor, unincorporated business, or a partnership or an S Corp, LLC filing a partnership or S Corp, you get all these business expenses. Tangible personal property, that's an IRS term. That's really your computers and your equipment. It's up to $2,500 per item. Computers, monitors, desks, mobile devices. You don't even have to bother with depreciation, which might be in your interest to do, by the way. You have to really see the vagaries of your federal and state tax return. But if let's say you buy an item for $3,000, so it's over tangible personal property de minimis rule, then you get your 100% Section 179 depreciation, which requires income either from a job or from the trading gains, the business trading gains. And if you don't get either of those, then you look at your 100% bonus depreciation. Lastly, you go for your regular depreciation. The new tax law did full expensing. They really beefed up full expensing up front. So you're getting write-offs right away. Businesses get the golden goose. You're amortizing expenses like for intangible property. Depreciation is for hard assets. Amortization is for soft assets. That's like your startup cost, Section 195. So you had a bunch of expenses in January to June. You started your trader tax status July 1st. You go back to January 1st. You capitalize your 195. You expense up to $5,000 first year. Rest over 15 years. Same for organization costs on setting up the LLC. Now, this is important because if let's say you have education expenses after commencement of TTS, so you started your TTS and then you went to a trading academy and spent $5,000 or $10,000. Well, it's a full business expense because it was after commencement. But let's say it was before commencement of TTS. In January to June, you went to a trading academy, you spent $10K. You started TTS in July, so you capitalize the $10K, you write off the expense limit of $5 and the other $5 over 15 years, or you use the accrual method instead of the cash method, and you apportion some classes that you still haven't taken yet to after July, and you get the whole deduction. It can get a little complicated. Check my guide. I have a whole chapter on business expenses on how to handle the education with all these nuances. What else do you get? Publications, subscriptions, market data, charting services, self-created automating trading systems. If you buy a canned system from someone else, you don't get credit on trader tax status for that. That's an investment expense that's not deductible, so you got to create it. Cloud computing, professional services, dealing with us, attorneys, you're outside attorneys, we're not attorneys. We have tax attorneys, but not legal services. Chat rooms, mentors, coaches, supplies, media, communications, travel, meals, no entertainment, TCJA, the new tax law, repeal the entertainment. Seminars, let's say you go to Las Vegas to see my partner Adam Manning next month. That's going to be great. He's got a paid session and a workshop that's free. Conferences, supplies, assistants, if you have the outside office rent, and consultants. So the list goes on and on. One big one I left off is right here. Home office expenses for the business portion of your home. There's a whole blog post, a recent one on how to do it. It was very popular on Forbes. I write for Forbes and for our website as well. It's a big deduction. You're turning 5, 10, 15, 20% of your home, every cost in that home, into a business deduction. You're not spending new money in most cases. It's the same money you're spending in your home. It's just a business deduction. You can still get an exclusion on the sale of the home. You just have to recapture some depreciation related to the home office. Check the blog post. I walk you through it all. Now, also margin interest. You don't have to bother with Schedule A. It's a full business expense on Schedule C or the Partnership 1065 or the S Corp 1120S. Stock borrow fees, if you're a major short seller. And maybe that wasn't as popular this past year, although there's always stuff to short. The markets can be great and there's always stuff to short. And short sellers do great, and we have some big short seller clients. You want to deduct every cost related to that. Otherwise, the rules can be very tricky for investors, and we have a lot of content on that. So, you're an individual. You realize you passed muster on TTS. You're eligible for the benefits. Just whip out a Schedule C in your tax software or tell your accountant or work with us on tax compliance. Presto, you're a sole proprietor. You didn't need to get a DBA. You didn't need to have a Schedule C. A brokerage account, it was your name with your social security number. Now, you might want to consider forming an LLC to be taxed as a partnership or S Corp for 2020, but it's really kind of too late to whip out a new entity for this year. If you could have done it for all of Q4, it might have made sense. But otherwise, now that you're not going to have it up and running until really November 1st, it's really too short. So follow this year-end strategy. You can form a single member LLC, taxed as a disregarded entity, a tax nothing in the eyes of the IRS in December 2019. Get your EIN, open up your brokerage account, but don't trade in it yet. Or if you do, it wouldn't matter. It'd be part of your individual return. There's no entity tax return because it's disregarded. But then you become a partnership with your spouse, or as a single member or spousal member LLC, you elect S Corp status as of January 1. So this way you're ready to hit the ground running at the beginning of January, and you can break the chain on wash sales from trading as an individual going into year-end 2019. It's a convenient time to switch business structures. So have your consult with me in November. Let's set up your entity in the middle of December, and you're ready to hit the ground running on January 1st. All right, that's part one of today's session. Let's see how we're doing on timing. Now, we scheduled 90 minutes today because we have a lot of content, and that's good because we're going to need the time. And I want time for your questions as well. So let me just drink some water. All right, now we're getting into part two, the tax treatment. Is it a security? Is it 1256? Is it forex? Is it a precious metal? Cryptocurrency and tangible property? Swap, ordinary income? Options of what kind? It can get confusing. Let's start with securities. People know securities the most, like stock, equity options. Securities traders, they have ordinary tax rates on short-term capital gains. So you make $100,000 in short-term capital gains, you have $100,000 from your spouse's job or your job. So you have $200,000 of ordinary income. There's no long-term capital gains rate. It's the ordinary rates. We have the brackets that go up. The new tax law lowered the brackets, compressed things a little bit. So that's one thing. Two, wash sale loss adjustments. We've touched on that earlier. You take a tax loss, you get back in within 31 days. The IRS says, you can't take the tax loss, add that to the basis of the replacement position. That's not a tax loss. That's because it wasn't really an economic loss. Capital loss limitations. You lose 25,000, you can only deduct 3,000. You got to carry over 22,000 to the next year. And accounting challenges. You can't just rely in most cases. If you're not active, you may be able to, but in most cases, you don't want to just solely rely on the 1099-B. Brokers do an excellent job, but they're following different rules from the IRS. You can't blame them for this. Securities include, all right, now we're going to get into the weeds because we're going to talk about stuff that the big media may not get into this level of detail because the average investor doesn't get into these instruments in all cases. So securities include, we're going to talk about that first, and next we're going to talk about what they don't include. So they include your U.S. and international equities, stocks, U.S. and foreign equity stock options, narrow-based indexes. There are very few of those, made up of 9 or fewer securities. Most are broad-based, like the S&P 500, the NASDAQ 100, the Russell 2000, the stock index futures. Most of them are broad-based. If they're narrow-based, they're treated like a security. Now, why does it matter? Well, securities have wash sales. If it's not a security, there's no wash sales. If you elect 475 as a TTS trader on securities, you don't want to elect it on commodities because you want to retain the lower 60-40 rates. You want to know what you can use ordinary losses on. If it's not a security, you can't use an ordinary loss. Like if you traded the VXX, that's not a security. You can't get an ordinary loss. This is why it matters. What's a security matters because then the wash sales hit you and you can avoid the wash sales with 475. So that's one reason why we want to know what's a security. Options on your narrow-based indexes. Now, exchange-traded funds, ETFs, those are not stock index futures. ETFs, securities ETFs, they're structured as registered investment companies, RIC. That's a security. Commodities ETFs are structured as a PTP, publicly traded partnership. Buy and sell that, it's treated like a security. And I believe our tax attorney thinks the wash sale loss applies as well. Now, generally when something is a security, an option on it is also a security. So an option on a securities ETF, so the SPY, a securities ETF, is a RIC, it's a security. The option on the SPY is also a security. Now, a volatility exchange traded note, ETN, structured as a debt instrument is a security. Now, you got to check prospectus when it comes to ETNs. Most ETNs are prepaid forward contracts, which are not securities, but your ETN, like the UGAS, is a debt instrument. We believe it's a security, so we tax it like a security. Bonds, if you happen to trade bonds, security. Mutual funds, if you trade mutual funds, security. Single stock futures are securities. We decided that years ago when they first came out. We don't hear a ton about them anymore. Now, securities don't include 1256 contracts. You want to be in the 1256 contract club. It's mark to market. That may not be great for you, but it gets those lower 60-40 tax rates with 60% long-term capital gains. So that's for your regulated futures contracts. And those are in all sorts of instruments, whether it's your currencies, your commodities, your energies, your financials, a whole list of regulated futures contracts on U.S. commodities exchanges. Notice I said U.S. commodities exchanges, 1256 contracts. We loosely, the IRS uses the term commodities, but that's what you're trading is your regulated futures contracts. The originals were commodities. Precious metals, those are not securities, those are collectibles. Bullion, collectibles. Now, what about an ETF that's based on bullion? It's structured as a publicly traded trust, a PTT. Well, again, you look to your underlying and then you look to your ETF. It's not a securities ETF. It's not a commodities ETF. What is unique about the publicly traded trust, a grantor trust? It's really a look through in a sense. So you're looking through to the bullion, which is a collectible. It's not a security. Now, what about your qualified board of exchange, like your CBOE, your CME, your QBE listed options? Well, are they non-equity options? That's key. We're going to get into this more later. So the ETF PTP, the options on ETF PTPs, so your options on your commodity ETFs, your options on your ETF PTTs, those we believe are 1256 and not securities. So volatility, you can go back and check this later on. We have also written blog content, and it's all more in the guide. I don't expect you to master it all. You want to go back and make sure you understand this. So your volatility ETNs, if they're structured as prepaid forward contracts, executory contracts, that's not a security. You check the prospectus, but you'll see it's not really a security. So the ETN on those PFCs are not securities. No, why is that such a good thing? Well, there's no wash sales, but it may be a bad thing for you if you were looking for a big 475 loss, like on the VXX, the most popular one. There's a lot of volatility moves. There's a lot of traders playing volatility. I mean, if volatility if the VIX is 13, if it's 20, if it's 25, if it's back to 20, if it's back to 15, those are some major moves. And there's some blow-ups on some of this stuff in the prior years, last year as well. And there's so many volatility instruments. You got to figure out how is yours taxed. Are you going to be protection with your 475 election that you have in place? You want to know that before you take a big risk. So if it's VXX, you're not going to have your 475 protection. Now, what about if it's cryptocurrency? That's not a security. It's not a commodity. According to the IRS, the SEC has different feelings about different tokens. Bitcoin and Ether is not a security according to the SEC. But even if regulators might declare something is a security, it doesn't change the IRS's opinion that it's intangible property. Intangible property is capital gain or loss. There is no wash sale, good, but there is no 475 tax loss insurance either. What about if you're trading forex in the interbank markets? Ordinary gain or loss, you can opt into capital gain or loss, but there's no wash sale, no 475. You don't need 475 if you got an ordinary loss from 988. Swap contracts, that should be ordinary gain or loss. Some people say that they're options and they're 1256 when we don't think that they are. I don't want to name names, but you want to drill down more. So again, you got your list of securities. Hopefully your broker is good on that and matching up. Then you got a whole bunch of stuff that probably is not a security where you may want to go against the 1099-B. What are you going to do now today? I'm mixing you up. Well, get the trade log software or sign up for our trade accounting service. Let us download the trades. The software is using our rationale. Some of the things you got to turn on and turn off. It gives you an optionality to do that, and you turn it on to our content. And you see where you stand going into year end on a potential wash sale loss report to see if you've been burned without having your 475 on some instruments, and you have something to discuss and to deal with. Now, it's a security. And I spent a lot of time on what is included and what's not included, and we'll save a little time later on where we go over that again on the different areas, like ETFs or options or 1256. But we're still in securities. This is the big area. The realization method, what does that mean? The IRS taxes securities transactions when a taxpayer closes an open trade. You go long, you buy a stock. Or you go short, you sell a stock, you open a trade. You're not taxed until you close the transaction. You have a closing trade. You sell a long position or you buy a short position when you realize the capital gain or loss. If you have some major capital gains you've been nursing this year on investment positions, you may want to try to hold on to them through year and maybe buy some protection that's not a straddle so that you can avoid capital gains taxes this year when you might have a large income from maybe high wages, a good economy or whatever. And you want to defer the capital gain into next year and maybe get into a long-term capital gain next year. That's wonderful with the realization method. I saw in the paper today, Congress may want to get rid of the capital gains rate, put everything mark to market, simplify the code. So much of what we just discussed today out the window, make it much simpler, but have everybody on MTM. A lot of people wouldn't like that they can't, how are they going to pay taxes if they haven't sold the stock? So remember, taxpayers can defer capital gains by holding it open. Conversely, with tax loss selling, so you look at your positions going into the year end, you hold the winners, you sell the losers. And then you wait the 31 days to break the chain so it's not a wash sale. Now the mark-to-market method, which I've alluded to on with 475 and 1256, it's different. It taxes both realized, like the realization method, and unrealized capital gains and losses at year end. So TTS traders are entitled to elect 475 ordinary gain or loss treatment on securities. That brings them MTM treatment. If you're a day trader, you don't have open positions at year end anyway. Most TTS traders don't have a lot of open positions at year end. They may have open investment positions, but those are duly segregated, and 475 MTM don't apply to duly segregated investment positions. Now, if you're trading 1256 contracts, MTM is built in by default. So again, you got your short-term versus your long-term capital gains and losses for your investment positions. STCG, your short-term capital gains, use the ordinary rates, currently up to 37%. For this year and next year. Now your long-term capital gains rates, they're significantly lower, and they don't apply to sales of securities held 12 months or longer. So you got in November 2018 and you sell in December 2019, you get your long-term capital gain. And why would you do that? Well, you don't have a job this year. You're in the lowest of the 10 or 12% bracket. And the long-term rate is zero. You want to take advantage of the zero rate. That's incredible. Next year, you may not be. You may be doing well again, have another job, trading, making money, and you're not going to get that zero rate because you're not in the lowest two brackets. A lot of people don't know that. That works for 60-40 too. If you're trading 60-40, you're single, you don't have a job this year, you're less than the 10 or 12%, let's say you're making $30,000 after your standard deduction. Your 60% of the 60-40 on your 1256 contracts is zero. So the 4%, you might only pay 4% tax rate or a 6% tax rate on the short-term portion. read our content on this. Take advantage of these maneuvers. Check out the brackets to understand where you are. Now, let's say you get stuck with a capital loss. Don't panic. Capital losses, including capital loss carryovers, they offset capital gains without a limitation. If you have a carryover of 100,000 and the next year you make 120,000 trading with capital gains, you're only going to pay taxes on the net of 20. You're not going to be limited to the 3,000. That net capital loss for the year is only limited to other income, ordinary income. So you lost 50 capital losses. Your wages are 100. You would like to write off the whole 50 and have 50 of gross income, but you're limited to 3,000 and you have to carry over 47,000 to the next year. Don't panic. Those capital loss carryovers, they don't expire. They're deferred tax assets. Hopefully you'll get capital gains one day, or you'll marry someone with capital gains and you'll file jointly and you'll get to use up your capital loss carryovers. You can't sell them. You can't pass them to another taxpayer. TTS traders, you don't want to rush into a 475 election because that's ordinary income. You might instead prefer to generate capital gains to use up your capital loss carryover and then maybe set up a new entity for a 475 election within 75 days of inception, or wait to the next year. And remember, you're not stuck trading as an individual. You can set up your trading entity for the S Corp for the health insurance and retirement plan and just have the S Corp pass through capital gains to your individual return where you're going to use up the capital loss carryover. So you will get a chance to use your capital loss carryover, but you got to do it in the right manner so you don't waste things. One second. All right, wash sale losses. They cause headaches, potentially higher tax bills. You want to avoid them. If a taxpayer repurchases a substantially identical security, Apple stock or Apple options, within 30 days before or after a tax loss, you take the loss on 12/15. You got back in on 11/20 and you held that through year end. That's where you have to add the tax loss to the basis. It's not just buying after, it's buying before. The wash sale rule defers a tax loss to the replacement position's cost basis. That can cause a deferral of losses at year end. So you think that you made 100,000, but your 1099-B is telling you you got to pay taxes on 150,000. What? Yeah, you have a deferred wash sale at year end of 50,000. What? I mean, that causes a lot of anxiety. And it's hard to understand those 1099-Bs, which are really reporting wash sale loss adjustments for the entire year, not just at year end. So how do you know where you stand? How can you look under the hood of the 1099-B? You can't. How can you find this information on their brokerage statements? You can't. Where can you find it? Well, run the trade log software, use our trade accounting service, see where you stand. For example, if you sell Apple, AAPL, at a tax loss on December 15th, 2019, and repurchase a substantially identical position in Apple on January 10th, the 2019 wash sale is triggered. Now, Apple's been a great stock, so maybe it's not the best example, but it still moves up or down. You might have gotten in at a high and sell at a low, as opposed to buying at the low and selling at a high. So you want to know what triggers the wash sale and then know how to avoid it. It's critical to avoid wash sales at year end in taxable accounts by breaking the 31-day chain. Sell by year end and don't repurchase a substantially identical position for 31 days. Now, let's say you don't have an IRA account. You just have taxable accounts. I don't care how many wash sales you had. I don't care if you have a wash sale every day of the year and you have a huge problem going into December. All I know is that if you get out of that stock before the end of the year and you have the discipline of not getting back into the stock or option in that position until February, so you can break the chain on the 31 days, that wash sale disappears. That's all I care about. Now, if you happen to also trade with an IRA and a taxable account, you could have a permanent wash sale loss that's horrendous. It's essential to prevent wash sale losses throughout the year between taxable and IRA accounts because that's a permanent loss. Your broker doesn't pick that up because remember, they only do the wash sale on the one account, not on your other accounts. But these are the IRS rules, and most taxpayers and most accountants don't understand that nuance. But we do apply that when we run the trade log software on all your accounts, including the IRA, not your entity accounts, just your individual accounts. Now, if you're a TTS trader and you elect 475, bingo, you're exempt from wash sales on those securities trades. Read my blog post, How to Avoid Taxes on Wash Sales. So you just want to click the link and go over to the post, and you'll see a download from Interactive Brokers on this. So just come to the website. You'll see all the blog posts there as well. Now, keep in mind, the wash sale rules are different for taxpayers versus brokers. We have a huge beef with the IRS over this because they have one set of rules for taxpayers and a different set of rules for brokers, and it makes sense. I mean, Interactive Brokers is not going to communicate with another brokerage firm for calculating wash sales. They have different software and different systems and different vendors. They can't do it. There's no way to do it. And the IRS would be really going overboard probably to ask them to do it for all their accounts. But the IRS knows that anyone can easily bypass the wash sale rules by selling at one broker A and buying back at broker B. So anyone could easily game the system, and that's why there are different rules. Taxpayers must calculate wash sale losses based on substantially identical positions in securities, that's Apple equity options, across all taxpayer brokerage accounts, including IRAs, and spousal accounts if married filing joint. Conversely, brokers calculate wash sales based on identical positions and exact symbol per the one brokerage account. So you may think, Bob, I don't have wash sale problems. My broker didn't tell me I have a lot of wash sales. I'm good to go. Hey, your broker didn't even tell you all the wash sales that you have because they have a different system. It's apples versus oranges. It's problematic because the IRS wants to match 1099-Bs to the Form 8949 prepared by taxpayers. After all, that's why they went out and did all that cost basis reporting. They went out to close the gap, but they left this major hole in everything. It's one reason why we want 475. Just makes things a whole heck of a lot easier. So you need the trade accounting software that's compliant with IRS rules for taxpayers or our trade accounting service that uses such software. All right, that was wash sales. Now, your ticket out of it is a 475 election. TTS traders should consider electing 475 on securities. So again, and stay with me here. I know this is a lot of content. We're at 12:55. We're 55 minutes in, a little less than that with the introduction. We're only going to go another 15, 20, 30 minutes. So just take a break for a second and gather your thoughts. I don't want you to miss out on this 475. Just taking a break for a second. All right. So you're a TTS trader. You got your business expenses. You're happy about that. But you also want your 475 because you're sick and tired of the wash sale discussion. If you have a loss, you want to mine it right away. You want your refund faster. And you're interested in that new QBI deduction. You made $100,000, all trading. You want a $20,000 or some portion of that on your tax return. Bingo, you want that deduction. It saves you a lot of money. So TTS traders may elect 475. It's ordinary gain or loss, not capital gain or loss. You can do it on securities only. You could do it on commodities too. 475 trades are exempt from wash sales, exempt from the 3,000 capital loss. It's an ordinary loss. It's a business loss. It offsets wages of any kind, any other kind of interest, dividends, rental real estate, whatever it is. Short-term capital gains, they're taxed the same as 475. They both use the ordinary rate. The benefit comes on the loss side, but also the benefit on the income side is the QBI deduction. Capital gains are not QBI. 475 is. 475 income is better than capital gains income. 475 losses are a whole heck of a lot better than capital losses because you can write it off against any other kind of income, and you can even have an NOL carry forward. Now, if you're a futures trader with 1256, you'd rather retain that. You don't want to elect it on commodities. And 1256 has a loss carryback election. We're going to go over it later. I'm jumping a little faster now. But let's say you start off trading January, and between January and March of next year, you lose a lot of money trading 1256 contracts. You don't want 64, you have nothing to carry it back against with the 1256 loss carryback election. You may want a 475 election because you have wage income that you can offset, or your spouse has wage income to offset. So there are times when even a futures trader wants to elect 475 on commodities, and then you can revoke it the next year. Know what decisions you can make, when the deadlines are for making a decision. Check it with me if you're not sure. It's really sad to miss the boat on something you could have done. The QBI deduction. It includes 475 income, not capital gains. It's for sole proprietors, partnership, S corps. Trading is a specified service trader business. It's not a manufacturing company. Manufacturers they don't have income thresholds to get away, to disallow the deduction altogether or phase it out. A service business like an accountant or a trader does. So you do have this threshold, phase in, phase out, taxable income cap. If you don't make a lot of money, if you're in the phase out, you get some of it. You can, on your 475 income, less your trading business expenses. So you made 100, 475 income, your trading expenses were 20, so you netted 80, and then 20% of the 80, 16,000 might be the deduction, or it might be less. There's a rationale for taking that treatment. It wasn't 100% clear in the regulations. Read our case for it. So MTM, it means you're marking to market at year end. We kind of went through this. It's included with 1256. And if you have 475, it's there too. Now you can segregate your investment positions and not have to use 475. So you go to your accountant. You trade securities and futures. Your accountant says, oh, skip 475 because you don't want that on futures. That was a mistake. You could have done it on securities only. Or the accountant says, oh, skip it because we don't want 475 on your investments. We want to defer capital gains and get long-term capital gains. Bad advice. You could have segregated it and gotten it on securities only. Make the right decision, folks. Here are the election procedures. You're a sole proprietor. You realize you have TTS for 2019. Great. You can deduct 20,000 of expenses. You have a big loss this year to date because it's been volatile throughout the year, up and down, market scares here or there, long, short, whatever. You want to use ordinary loss treatment. Too bad you missed the boat on that, folks. You had to elect that by April 15th, March 15th for existing S corps or partnerships. And then your second step would be, if you had done the election, you'd file a 3115 change of accounting method with your 2019 tax return. So you might want to consider a 470. You missed it for 19. If you don't have a capital loss carryover going into next year, you might want to elect 475 for next year by April 15th. And there's a lot of decision making to make about that, whether what your carryover is, deferred wash sales or not, how you made out in Q1 or Q1. I want you to read chapter 2 of my guide on that. Get the 019 guide now, you'll get the free 2020 upgrade. There's a lot of decision making to make. So many times I speak to people who made the wrong decisions. It's sad. Now, if you're a new entity, there's a loophole. You can elect 475 within 75 days of inception. But if you set up the entity now, I think November, December is really a little too short a period to claim TTS. So I think you're more looking at the new entity for January 1st. So if you set up that new S Corp or partnership, it's 75 days from inception to make the election. That's what people did in Q2, Q3, Q4 of this year. But now I think the window is closed on that for 19. All right, let's talk about 1256 contracts. I'm going to try to get all this done by 1:30 and then answer some questions as well. Let's see how we're doing, by the way, with the room. So 1 second. Take a quick break. I want to see how we're doing on in the room. Good. We have a lot of attendees that are still paying good attention. I don't think you want to miss any of this content. If you have to miss some of it, don't just go back and watch the recording later on and scroll to the section that you want to focus more in on. All right, so let me just minimize this again and go back to the full view. All right, 1256 contracts, golden goose. They get the lower 60/40 capital gains rates. 60% is the long-term capital gain, even on a day trade. Summary tax reporting. You don't got to report every trade line by line like you do with securities. And it's so much easier with mark-to-market accounting. So you got one-page 1099-B, and you do rely on it. You don't need a trade accounting system for 1256 contracts. If you're trading both 1256 and securities, you may want a system. Now, so what do 1256 contracts include? Your U.S. regulated futures contracts, your RFCs, your option on your U.S. RFCs, your U.S. broad-based indexes made up of 10 or more securities, also known as your stock index futures, your S&P 500, NASDAQ 100, Russell 2000. All those, the key thing is that they're indexes, so you take the symbol, you Google it, you look for your Yahoo link. You see, is it traded on a securities or a futures exchange? Does it say index or does it say ETF? That's where the big difference is. The SPY is an ETF, but the stock index future is index. I mean, it's a 1256 contract. So in each one of those instruments, you can do either the ETF or the index, and you want the index is 1256, the ETF is not. So your options on broad-based indexes are the same. So your foreign futures, if they're granted 1256 treatment, and we'll go over the list later on, most are not. So if it's a foreign future, you better see that there was an IRS revenue ruling granting 1256 treatment. Non-equity options, it's kind of a catch-all. Those are 1256. So here are some of your non-equity options. Your QBE listed options on commodity ETF publicly traded partnerships, PTP. The QBE listed options on the precious metals ETF, PTT. We went through this before. Your QBE listed options on your volatility ETN prepaid forward contracts. Forward forex contracts with the opt-out election into 1256G. We make a case for spot 2. And your forex OTC options. We went through some of this before. We're going to go through a little bit more of it later, so I'm going to jump through in the interest of time. What are your tax advantages of 1256? We had a whole separate webinar on this a few months ago, so go back to that as well. You get the lower 60/40 rates. 60% is a long-term capital rate. Remember, it was 0 in the lowest 2 brackets. It was 15% in the middle brackets. It was 20% in the top bracket. So what is the 60/40 math? If you're in the top bracket, it's 26.8% versus 37%. It's 10.2% less. There are significant savings throughout the brackets. There's a table on our website where we go through all those brackets. Check that out. Major savings throughout the brackets. MTM, unrealized and realized. We've gone over that. Now, let's say this year, you lost a lot of money in futures. And you want to do this loss carryback election. So on Form 6781, you'll check the box D. You know you had 1256 gains in the prior 3 years. You'll file a Form 1045 or a 1040X to carry it back. Only 3 years, only against 1256 gains. And if you don't use it all up, you'll carry over the rest to the next subsequent years. It's the only carryback left for traders because your NOL is no longer a carryback. It's a wonderful thing to have that 1256 loss carryback election. Options. Tax treatment for options is diverse. There's simple outright trades, complex trades with multiple legs. We're just going to touch on options today, and I want you to check out other content we have on it. I'm going to do a webinar just on options coming up in the new year with IBOR in December. I think it's time to do that again. So you got options that are taxed as securities. So your equity options, those are securities. Your options on your narrow base indexes, very few of those securities. Options on your securities ETFs, organized as RIC. So your options on the SPY, those are securities. Here's the general rule. If the options listed on a QBE, a qualified board of exchange, your commodities exchanges, in general, a QBE listed option, it's probably a 1256 contract unless it references a single stock. That's why an equity option is not 1256, or it references a narrow base index. And the RIC is sort of like a single stock. So that's why the option on the securities ETF is a security. Otherwise, all your other options are non-equity options, 1256. So the options on your futures, your options on your commodity ETF, your options on the precious metal ETF, your options on the volatility ETN, and the forex OTC options. So three things can happen with your outright options trades. You trade the option, that's a closing transaction. So you buy your equity option, you sell your equity option. It's sort of like just regular, like a stock. You got your buying price, your selling price. You might have a wash sale if you get back into the next month. Now, some brokers have software that they recommend that may not pick up wash sales between different option expiration dates. We don't think that's right. So your option could also expire, it could lapse, or you could exercise the option. It can get a little more complicated. There are special rules for holding period for long-term capital gains. So go over to this blog post about it. We get into a lot more detail, and we'll have an upcoming webinar about it as well. Let's talk about ETFs. Securities, commodities, and precious metals ETFs use different structures, and tax treatment varies. So your securities ETFs, we talked about this earlier, your SPY, they're RICs. You buy and sell them. It's like selling a security. It might be short-term, might be long-term. It's a realization method. Wash sales apply. If you have 475, that applies. Your securities ETF is just like your regular security. Wash sales, 475. Commodities ETFs are a little trickier. They're publicly traded partnerships. They can't use the RIC structure. They may give you a K1 passing through some 1256 treatment. Okay, you got to pick that up on your tax return. You didn't get a check for that, so you got to add it to your basis, because otherwise you're going to double count. So you buy and sell the ETF. It's like selling a security, short-term, long-term, but you got to adjust your cost basis. The software won't do it. The K1 won't do it. The 1099B won't do it. You have to take a manual adjustment to your 8949. Otherwise, you're going to double count the income. Ouch. The trade accounting software won't do it, but it will let you make the manual adjustment to add the basis. So wait till you get your K1 and then do it in the software. Sell your commodity. If you sell your physically backed precious metals ETF like your GLD, that's a grantor trust. Again, you might get an annual K1 passing through some collectibles capital gains, but you may have to add it to the basis. And if you sell the ETF, you're not selling a security. There's no wash sale. There's no 475 because it's not a security. So again, it's like selling a collectible. It's like selling the bullion itself. But the option on the GLD, we think that is 1256 because it's CBO. It's listed on a QBE, and it's not, the underlying reference is not a security. It's a collectible. You see how the rationale works? So your collectible, if you hold it a year, it's the long-term rate, but it's a special long-term collectibles rate up to 28%. But let's say your ordinary rate is less than 28%. So you're not paying 28%, you're paying the lower of. The cap is at 28%. Otherwise, if it's short-term on bullion, you're paying your regular ordinary rates. But again, it's not a security, so there's no wash sale, no 475. You're probably starting to pick up the rationale here on the different things to understand why something is the way it is. Boy, wouldn't it be nice if the IRS simplified all this and the new tax law didn't touch any of it. And if they go to touch it, people will cry foul because they want to defend 60/40. I did that in the New York Times years ago. I was arguing for 60/40, and Warren Buffett was arguing against 60/40. You can find that on our website. Forex is totally different. It's ordinary gain or loss. It's summary reporting. You can make a capital gains election. Ordinary losses are nice. They can offset wage income. But if you have a big ordinary loss and you don't have any income to offset and you don't have TTS, you might waste that loss. So you want to make the capital gains election. The capital gains election will use up your capital loss carryover. And then if you're trading the majors, you can navigate into lower Section 1256G, lower 60/40 tax rates, and you can file this capital gains election on a good to cancel basis. So this is Forex in the interbank market. This is not your currency futures. This is Forex in the interbank market. And it's the 60/40 is only on the major pairs for which futures trade, and read my blog post about this. It's very tricky and it's highly nuanced. If you're a major Forex trader with big positions, you got to read this content and check in with us most likely. Now, there are other financial instruments as well. Foreign futures, we talked about them a little bit already. Precious metals, we talked about. Volatility products, we've talked about, including the ETNs. So foreign futures by default, they're not 1256. You got to join the club and the IRS has to give you a ticket. So the CFTC has to approve you as a foreign exchange for marketing to Americans, but that's not enough of a ticket. You also need an IRS revenue ruling. There's only been a handful of those. See, here's the list. Eurex, Life, ICE Futures Europe, ICE Futures Canada. They have 1256. The others don't. Foreign futures are otherwise short-term or long-term capital gains, tax similar to securities with the realization method. Precious metals, collectibles, we went through this already. Volatility financial products. There's a whole bevy of them. The VIX futures, those are 1256, 60/40, MTM, because it's a volatility index. Check it out. It's a futures product. Now, the NYSE traded, that's a securities exchange. That's already a hint. Excuse me. The SVXY, check it out, the symbol. You'll see it's an exchange traded fund. It's an ETF. It's taxed as a security. Just like stock, it's got wash sales. It's got 475 if elected. Now, what about the VXX? That's an ETN prepaid forward contract. It's taxed similar to ETFs, but there are differences. As I pointed out before, the prepaid forward contract is not a security. So it's taxed like a security with the realization method, but because it's not a security, it's not wash sales and it's not 475, and you may vary from your 1099-B. Now, if it's an ETN debt instrument, we think that is a security. So you really have to check the prospectus for tax treatment and check in with us. And if you're departing from the 1099-B on a big position, you may want to get a tax opinion from our tax attorney. He can issue it from his outside law firm. So check in with us. Lastly, cryptocurrencies. We'll go through this a little quickly. Selling, exchanging, and using crypto triggers capital gains and losses. It's intangible property, not a security. Not a commodity. So no wash sales, no 475, no 60/40, and it's not currency. So there's no ordinary loss from currency. So it's none of those things that we've discussed earlier. It's unique, intangible property. It is the realization method. That's good. If you were a holder, you didn't take a big loss, you haven't taken a gain, you're holding for a huge long-term capital gain, there's been huge volatility. That's good, the realization method. But if you've invested in cryptocurrencies and sold, exchanged, or spent some during the year or prior years, you have to report a capital gain or loss on every one of those transactions. on the Form 8949 with line-by-line reporting. That includes your cryptocurrency to currency sales, your fiat, you sold Bitcoin for cash, for dollars. It includes your crypto to alt crypto, your coin-to-coin trades. You traded Bitcoin for Ether, for Litecoin, for a whole long list of coin. A lot of games playing with that. People thought that wasn't taxable. It has always been taxable. Well, let's say you use Bitcoin to buy a car or a hotel room or a cup of coffee. Every use of it was a capital gain or loss. Now, if you've been on a U.S. crypto exchange, the IRS has kind of forced them into issuing 1099-Ks, which is really for merchants. It's inappropriate for traders. If you've hit certain thresholds, they've been issued, and the IRS sees what you got. They also use chain analysis to go into the public distributed ledgers. It's all out there in the public. Chain analysis software showed them how to get the names or the identifying numbers behind it. They have the information. They sent out the letters to the people that you're cheating. We know who you are. Come clean. Now, there's also a problem where the IRS doesn't see a lot of international exchanges because there is no 1099, although the chain analysis may have busted some of those too. So you got to download all your crypto transactions into crypto accounting programs and turn on the right methods in the program. I think wash sales do not apply to intangible property. That's good, number one. The new tax law restricted 1031 like-kind exchanges to real property only in 2018. So if you were deferring capital gains and losses on coin-to-coin trades in the past, in 2017, 2016, 2015, you didn't report your Bitcoin for Ether, for Litecoin, and back and forth trades. You only reported your crypto to fiat currency trades, to dollar trades. You were doing 1031 like-kind exchange deferral. Couldn't do that in 18. There was ruled out for real property only. But what about before 18? There's new crypto guidance that just came out. They didn't say anything about the prior like-kind exchanges. I thought it's questionable. I thought you could never do it because Bitcoin is not like-kind property with Ether, but the IRS has not said anything about it yet, and I really wish they would. Now, their new guidance that they just came out with just a week or so ago, which came out after I gave these slides to IB Compliance, so if you get the download, it doesn't have this recently issued guidance with link, which I put in here now. They did give guidance on the hard fork. So if you had a hard fork of Bitcoin for Bitcoin Cash, that was airdropped. You got the Bitcoin Cash dominion and control. So that was ordinary income. But if you had a hard fork where they didn't airdrop you anything, they didn't give you anything with dominion and control, nothing to trade yet, it was maybe in dispute, that's not yet ordinary income. Now, intangible property is specific identification. If you have just a few transactions, you bought some Bitcoin at $500, you bought some at $5,000. You sold it, you want to say, hey, I sold the one for $5,000, the last in, first out, because you specifically identified it and you told the exchange that, you gave them the number identifying, and maybe that worked for you. But if you're a trader, you're not following the rules for specific identification. There's just simply no way to do what's necessary. The new guidance from the IRS tells you exactly how to do specific identification. I don't think you can do that as a trader. So the fallback position is to use FIFO, first in, first out. If you're a trader and you're going to cash by year end, it doesn't matter. You've cleared out all your inventory anyway. But if you're a holder that's gotten in at different prices, this can have a meaningful effect on you. So check out the new guidance. Check out my recent blog post about all those letters that went out to traders. There were 3 different versions of the letters. The IRS talked about them being educational notices. If you haven't gotten a handle on your crypto, if you're behind on your reporting, check in with us or other vendors. There's a lot of people in the space now. Get the right software, download everything, come clean. Don't wait for the IRS to bust you. The penalty regime can be much higher. This is like the offshore busts and the voluntary compliance which they had, which is stopped now for offshore hiding. But this is similar, a lot of similarities. Come clean on your crypto. Let's get into some questions and answers. Sorry, folks, there was a lot of content today. We have time for questions. We'll go a little later in as well. But if I don't answer your question, email it to info@GNMTraderTax or GreenTraderTax.com. When you call us, we may not answer because right now a lot of our people are off. We just finished tax season on October 15th. My partners are off today, for example. Our admin team may be off as well. So you want to follow up with us by email. I answer a lot of the emails. So the best way to get me is with the email. Otherwise, if you call or chat, you're going to get my partners or administrators. So you want to then come back to our website and let's look at your questions. This, by the way, was that crypto, the new guidance. You want to be on my blog post, by the way, because that's where I put out a lot of stuff. On my Twitter account, because you want to join that, because that's where I put out stuff, the webinars, but also, for example, you'll see here was the crypto guidance and what I had to say about the like-kind exchanges. Let's go to the home page and at the same time go to your questions. Let me just drink some water. Going to be looking at your questions. We still have a lot of attendees here, so hopefully I'll get to your question. I'm going to do these kind of quickly. I know IB likes it when I answer questions. So if they like it, if I go a little late to answer them. Normally I go late I do 60 of content and 30 with questions, but today we had a lot more content. Sorry if I maybe should have broken it down. All right, so I have questions in front of me now. Do options for futures get same? Yes. If you look at the option, you look at what it references, unless it references a single stock or a now index or a securities ETF RIC, it's a non-equity option and it's probably 1256. That's a good rationale. Scott B, and I'm using last name initials so that we keep client anonymity or people's anonymity. If I trade futures under an LLC in a taxable state X, but some in vacation taxable state, we're not really allocating to the non-taxable state. You're a resident probably for the full year. And even if you set your entity up in Delaware, if you're live, work, and trade in New York, that's where your past due entity is going anyway. So you're not really having games with states. I think it's a more nuanced question, Scott, so you want to follow up with me. I'm going to try to skip over multiple people's questions and get to first questions only because there's a lot of questions on the board. Aaron L. If FINRA considers anything over 4 trades per week as a day trader, then why is it so hard for IRS to qualify? Well, you might be a patent day trader for some weeks and not every week. So the rules are different. Remember, regulators are different from taxes, but you kind of want to be a patent day trader to have a good shot at TTS. I'm looking at these questions quickly, folks, trying to decipher the gist of the question and then answering that. I may not answer your question exactly or pick up on every nuance, so email it over to me to get a little bit of a more thoughtful answer. Justin D. Given recent tax liability, investors can't deduct investment management fees. Pools, they would want TTS. So again, I have a whole blog post about the new law for SMA versus pools. So if you're a pool and you don't have TTS, you want to use the carried interest, the profit allocation, so the investment manager gets a share of 60-40 or a share of capital gains. Because otherwise, if the pool and the SMA never has TTS, the pool can have TTS if the manager brings TTS to the entity level. So the SMA stuck with no deduction for the investment fees. Family offices are hit too. So read my blog post about that from late last year or Q3 last year. CD, data fees, activity fees charged by broker. Now it's really interesting because some brokers have gone to reduced or no commissions. Commissions are deductible as part of capital gains and losses. They're not separately stated expenses. Some of those brokers are moving more into fees, but those fees aren't deductible because they're investment fees and expenses. So that's interesting to see the tax aspect of that. Mertui K. How does one actually make the election? You don't elect TTS, you claim it, but you elect the 475, and that was by April 15th. So check back. Now, some of your questions were before we got to the content. So it's not that you weren't listening, it's that you were very perceptive to ask a question before I got to the content. So as I start these first set of questions, that's usually the case. Preston D. What does the individual trade dollar amount of the trade need to? You don't have to have. I try to get off dollar amount because some people don't have a lot of money. Some people have a lot of money, bigger, smaller accounts. Some people may have proceeds in the millions or less because they don't trade big dollar numbers. So it's really what's material to you, but I don't really talk about that too much in the golden rules anymore, whereas I did more in prior years. Matthew D. If the rules to qualify require 4+ trades per day, you're doing that. You want to look at your investments separate from your trading positions. If you're trading in an LLC, that's separate from individual. Look at who is the trader and only focus on those trading accounts, not investments, and hit the numbers that way. TJP. If you wanted to form an entity next year, would be the best time. Maybe in the middle of December or early January. Again, follow that strategy for the SMLC disregard entity in December and then hits the ground running for January start date. Or we just get started the first week or two of January. Craig N. What are the due dates for 401k? You got to open that before year end. You can fund it, the elective deferral by the end of January, and the profit sharing plan by the due date of the return, including extensions, which is September 15th. So you do your year-end payroll through the S Corp. You do your elective deferral. You pay that by the end of January because it's December payroll. And then the profit sharing plan up to 37K, you don't have to fund that until 9/15 if you're on extension with your 2019 S Corp return. All right, a lot of repeat questions. Gary W. Yes, the recording after. Gurig Bal S. If there's a third-party software you review correct 1089, wash sales, multiple legs, one leg, choose profit. Yeah, so you want to use TradeLog software or our trade accounting service using TradeLog to do the wash sales correctly based on our content, which we shared with you today. It is going to differ from the 1099B if you have a lot of those areas that were in question. So you're going to have an overall footnote that explains why there are differences so the IRS can't match it all up exactly. And if there's some big numbers involved, there was some major savings, we may want to get the tax opinion letter as well to show that there's substantial authority to take the position. That's key, that there's substantial authority. There's authority for the broker to take the position they did, and you have substantial authority to take the position you took. If you don't have substantial authority, then you can't take the position. So your local accountant may want some hand-holding on that. And if we do your trade accounting service, we, in a sense, do that part of the return and help out with the rest of the return. But we can't just do part of your tax return. We either do your whole return in our tax compliance service or just our trade accounting service. And then you can do some consulting with us. So this is really where there's a lot of money on the line, folks. And don't just, shrug it off. You may come to us and say, Bob, I need a 475 on a $500,000 loss. But if it's VXX, it doesn't apply. But the broker picked it up as a security and you think you can apply it. So you may find that you don't want to use our advice because you're better off with the broker's 1099B. You have to see what you want to do and discuss it with us in a consultation. We don't do things based on only what's best for you. We do things based on what we're supposed to do according to the IRS rules. And we call the balls and strikes the way we see them. And that's how we maintain our credibility with the IRS to win for our clients when they need us to win. James T. If the tax law changes to capital gains tax, no, there's no tax law change on that. It's a 3,000 limitation. It's always been 3,000. It's not indexed for inflation. The QBI thresholds are indexed for inflation. The tax rates are indexed for inflation. the Social Security base for paying FICA on, wages in your S Corp, that's indexed for inflation, and that just jumped up. Daniel N. If the slide about what is a security, you mentioned broad-based indexes or not. No, the slides are clear on that. Go back and take a look at that again, or send me your question again. It's a little nuanced, Daniel. They should all correlate and match up. I was careful. It took a lot of time in preparing them. Greg K. Yeah, you get the slides in the download. You can also check our recent blog post, which has the same content. A lot of multiple questions. DWT. If I trade only 1256 in an LLC, have no income to report, only losses. Well, you're not going to have QBI. You'd have a QBI loss if it was 475, but it's not 475. 1256 is not QBI. 1256 losses are not QBI losses. Only your trading expenses are negative QBI. So there's a plus and minus to QBI. QBI losses could aggregate and offset your other QBI from maybe you're a lawyer or an accountant or some other service business. QBI is a whole other can of worms. Arturo L. What do I have to do to get a loan out of an old 401k? You can have a solo 401k with, let's say, a broker that offers a plan loan. It's a qualified plan. So you can do a qualified plan loan. You can't do it with an IRA or a rollover IRA. You can do a qualified plan loan up to $50,000 or 50% of plan assets, a lower amount. Use a market rate of interest, pay it back over no longer than 5 years on a quarterly basis with a fixed amortization schedule. I cover that in my guide. Griffin S. By the way, Cynthia, if you need to jump in and stop, do that at any time. But I'm still on a roll here. I'm going to try to get everybody's first question in. There's not that many more of those.
Well,
Griffin.
Keep going, Robert. Thank you.
Okay. And then I'll circle back a little bit. Griffin S. Does the partnership have to make the forex election? Yes. Or the individual. The trade, where the trades happen, is the capital gains election. So it could be in a forex fund. And you want to point that out in a footnote to the taxpayers so their accountants understand it. Anytime you do something for a hedge fund, you got to be a whole heck of a lot surer of everything and clearer about everything, because you're affecting investors and their accountants. It's not just your own money with your own trading company, which most of our clients are their own trading company. Let's see, there's repeat Jigar P. Does the number of trades I make in the IRA, they don't count towards the TTS. You're looking at only taxable accounts for the TTS, not the investment, only your TTS trading accounts. Dorothy R. What is my Twitter? So go over to the home page of our website and you'll see Twitter right up top. At GreenTraderTax is the Twitter handle. Thank you. Max C. If you created an LLC this month, well, if you got it going in October, you might still get TTS, but if you don't get it going until the mid-November, I think it's too late. You're on the cusp right now. Arul N. If I have a full-time job, can I still qualify? Yes. Just make sure you hit all our numbers, because it's not that it's a higher bar, but there's less leeway. Raghu R. How much should we plan for costs related to forming an entity? So you have the consult with me for $250. The entity formation is $425. It includes an hour with me and 15 minutes with my partner for follow-up. The outside attorney is $235 to execute all the paperwork. The online incorporated $99. The state filing fee is $100 and change depending on what stage you're in. That gets it up and running one time. Charles, and that's on our entity formation page. Charles M. If you have a few trades greater than 31 days, that's okay, because we're looking at average. But I get a sense real quickly if you tell me, Bob, I'm trading options, I'm really looking out 45, 60, 90 days. I do close trades, usually around a month. I have some equities I hold too. It's starting to sound like you don't qualify. But, I day trade, I swing trade. I'm usually window of 2 weeks. But there are some outliers that I hold over a month, could even be 2 months. 50% day trading, 40% swing trading, some goes out. Hey, it sounds like the average is well under a month. You want to really crunch the numbers, but I can get a good feel from how you talk to me. That's why I don't give you, let's say, a checklist, and I try to give you too much before the call, because I really want to hear you tell me about things the way you know what you're doing, usually with your numbers, and how you sound really affects how I feel about calling the balls and strikes. There's a World Series now, so it's a good metaphor. And then you can always go back and drill down on the numbers to see really if you struck out or not. And then again, that was just planning or really what you think. When you work with us on tax compliance, we take another fresh look at the facts. What you told me in a console could be different from what our CPAs see when they take the bread out of the oven preparing your return. Charles M. We just did that one. Max C. I did yours already. Dorothy R. No, you got the Peter F. 1256 meet TTS. So you got TTS for, let's say, Q4. I know you just said, so your Schedule C would be just for Q4. Your 1256 is year round. Francis D. I just opened LLC. Currently have 4 brokerage accounts. Can I claim 4 personal? No. If this is a big no, Francis. A lot of people tell me all the time, oh, I set up an LLC, but they never opened up an LLC trading account, and the 1099 goes to them individually. There is no trading in an entity. It was on the shelf. It was inactive. The trades have to be in the entity account, and there could be higher professional data feed fees for the entity account. So you want to make sure the entity really helps you before you just jump into one. Usually you want to look for a good health insurance and retirement plan deduction. Greg K. Which of your service to help TTS? That's the consult. We go through TTS, what it might take to get it if you don't have it, tax treatment elections, what you should do on your return with tax treatment, whether you need an entity or not, how you should set it up, what type of entity. All that we go through in the consultation. David V. Clearing firm confirms all multi-legged. How do I count them? If you put on the legs separately and you have different confirmations for that, you can probably count them separately for TTS. But if you just hit the button and the broker breaks down the legs for you, then it's hard to claim the legs separately. That's highly nuanced, and I cover that in the guide, and I could cover that in the consult with you. Now it's all remaining, multiple questions. A lot of people had 2, 3, 4 questions. Those are people that might want to consult with me, but send me your questions. I'll try to give you a quick answer by email. If not, I'll recommend the consult, or just go ahead and sign up for the consult, one or the other. So it's probably a good time to go back to you, Cynthia. And I'm sorry it was a lot of content today. Maybe in retrospect it should have been 2, but hopefully people can break it down and listen to it in separate sessions if they want. So thank you, Cynthia. Everybody, we'll hope to work with you soon.
Well, Robert, I want to thank you for quite a bit of information, and remind everyone, if you do want to come back and review what Robert discussed today, simply watch your email later on this afternoon. I'll be sending out both today's recording and the slides that were available or were used for today's presentation. So with that, we are going to conclude our event here today. And by the way, before you leave, I do want to remind you, Robert's going to be back with us on November 13th to discuss tax planning at year end to help generate savings. So with that, by the way, that event is listed on the Interactive Broker site, available from underneath the education menu. You'll find the webinar section where you can sign up. And if you do sign up and are not able to attend these sessions, you'll still get a direct link to today's recorded playback. So with that, we're going to go ahead and conclude our event here today. Thanks to all of you for your participation, and have a great rest of your day, everyone. We look forward to talking to you one more time coming up in November. So thanks very much, Robert. And all have a great day. Thanks, everyone. You can all exit using the X in the upper right-hand corner of your screen.